It is Monday, November 17th, and welcome to your weekly market update with Nikki Erickson. How are you?
Good. How are you guys doing? How are you doing?
Fantastic.
Good. Well, I want to kind of start the week off a little bit with talking, of course, about interest rates and where we're at from a market perspective. The interest rates are actually creeping up a little bit now that the government shutdown is over and things are coming back into normalcy. We we have seen the bond market bounce back from that. So late last week, we saw interest rates come back up into the mid six range, and now they're starting to come back down into that lower six range, but we're still not quite back into the fives yet. So that was when the government was shut down. We saw some, ability to get into the 5.5, 5.875% interest rate area. But now with the government back up and running and the bond market a little bit stronger, we're seeing those interest rates come up a little bit. This week we will have the BLS jobs report, and they're expecting a weakened labor market, not as many jobs as projected. And the overall theory is that those reports are actually more accurate now than they have been in the past, as far as job creations and things of that nature. So that we'll see what happens there as far as its effect on interest rates. Overall, the feeling from the market, the feeling from the economy is that if we take out the tariff monies and tariffs influence on inflation, we are seeing inflation come down quite a bit, actually. So that's good news. So as these things start to correct themselves, we'll see the interest rates come down and down. There have been some experts in the field that have said that we should be able to realistically get down to interest rates at 3.5%, but they, of course, don't say how long I think that's going to take. So we'll see what happens. We're hoping to be well into the fives by the end of the year, but again, we shall see. Beyond that, the two big topics that the Trump administration has been talking about with regard to the housing shortage and regard to mortgages in general is introducing the idea of introducing a 50-year mortgage. So probably a couple of years ago, the idea started to float around of a 40-year mortgage, and you could actually find 40-year mortgages in the market. The interest rates were obviously higher than what you would find on a 30-year, but they didn't really gain in popularity because that extra 10 years obviously adds a lot more interest and a lot more, time onto the mortgage. The concept of this 50-year mortgage is just saying like, let's get some payment relief for increasing housing costs. And the idea behind it is that, obviously it lowers your payment when compared to a 30-year mortgage. What the general idea of it is people, in general, it wasn't really a favored idea at first. But then if you really think about it, for a first-time home buyer or someone who is going in to purchase a property where they're only going to be in this property for 5 to 7 years, or that's their actual plan, it's not entirely, in my opinion, a bad idea to consider a 50-year mortgage. The reason for that is anytime you do a mortgage, no matter what the term is, most of the time, let's talk about 30 years, you are paying interest for the first 5 years. You're paying a lot of interest in the first 5 years, and barely any principal off. So the same, theory applies to the 50-year mortgage. You're paying interest, you're not paying much principal off. And, if you're only going to be in the home for 5 to 7 years, does it really matter if it's a 50-year mortgage? And so, my personal opinion is it's something definitely to consider if it does get pushed through. It'll probably help a lot of first-time home buyers, definitely help a lot of people who, are in their home right now with 2 to 3% interest rates. Maybe consider moving to another home or upgrading or doing whatever they can in order to accommodate for that. The other option or the other idea that the Trump administration has presented has centered around the idea of transferring your mortgage note. So, in other words, the interest rate that you have on your current home, transferring that note from one property to another. So, you rewrite that note at the same interest rate with the remaining term for the next property that you own. This is kind of a back and forth, like, will this work? Will this not? They say that, if people were able to take their 2% interest rate, let's say they owe $300,000 on their mortgage and at 2%, and they were able to grab that remaining amount and transfer it over to another property, they say that it would predict about 44 million more listings to come out if people were allowed to do that. So it's an idea that's out there. Of course, nothing has come to fruition, but it's definitely something that the administration is working with FHFA on, from a Fannie and Freddie standpoint to say, okay, how are we going to really come up with some good long-term solutions to, make housing more affordable. And, if we really think about it, it's quite the undertaking to take a mortgage note that is attached to a property and requalify the borrower for any additional funds and go to the next property. But that's all semantics. Of course, that'll all be worked out. But yeah, the recording process, the mortgage process, the attaching the lien to the property, those things are going to all have to be worked out. So it's just an idea that's been floating out there, to transfer that, mortgage note to the next property. And of course, then they don't solve the problem of, let's say you have, 300,000 at 2%. What if you want to buy a $500,000 house? Where are you going to get that extra 200,000 if you don't have that much equity in your current home? So a lot of things to think about and work out, but it could be a possibility. It could help some homeowners, that are currently in a two-bedroom home and, are having kids and need to go to a three-bedroom or whatever that is. So it'll be interesting to see what happens.
Yeah. Are there any timelines that you can forecast or foreshadow of either the 50-year or that the
I I have a feeling the 50 year is going to be the bigger push than the transferable mortgage. There's no set timelines right now. It's just something that they're talking about, because, on the administration's agenda, housing is one of the, hot topics and something that does need to be resolved. So it's just a matter of how are we going to, are there going to be some positive changes that are happening? If you remember, we were talking like 3, 4 months ago about the Vantage score coming into the mortgage industry and being able to be used, for qualifying buyers. The Vantage score, of course, is a different than FICO score. It talks about more real world, like paying rent, paying utilities, things of that nature, and scores you based on your everyday living versus just what reports to credit. That is allowed in the industry, but zero changes have been made to software systems, um, running of automated approval systems, things of that nature. No progress has been made on that. So although we are allowed to do it, there's just not the technology right now that they've worked on in order to do it. So it'll be interesting to see it. I mean, even that's going to take probably another year to come to fruition. So yeah, these 50-year mortgages, who knows?
Yeah, I was hoping you would address that because I tell you what, the internet
Mm-hmm.
going crazy.
Mm-hmm.
And I mean, and people either have, I mean, there's some really strong feelings out there.
There are.
Yes, and I was like, wow. So I'm glad because there are some instances. I mean, there's two sides to everything. This polar opposite. So I saw a lot of reacting,
Yes.
not responding
I
to
think the
this.
negativity comes from, people saying, oh, if you're 30 and you buy a house, you won't pay off your house until you're 80.
Mhm,
And it's like the chances of somebody even staying in a home for 30 years
mhm.
are very slim to nil at this point anyway. I mean, people usually move every 5 to 7 years.
Yeah.
So if you really think about it, yes, you are paying more interest to the banks over time if you were to get that 50-year mortgage. However, the first 5 years of that 30-year mortgage, you're paying all your interest anyway. So it's just something that, for me, it's, and just the clients that I help and the things that I see, it's like, you know what? There was a big uproar when mortgages went from 15 to 30 years too.
Yeah. It is, and it's just kind of it is a tool
Mhm.
that can be used in some instances. It doesn't have to in every instance, and it's not going
Yep,
to be right for everyone, just like
exactly.
nothing is. So
Yeah,
I love that. And I know I've heard a lot too about like the administration looking at how to bring more builders in and how
yes.
to get the new construction up and going again. Do you have anything on that front to share?
Yep. So what they're trying to do is say, okay, instead of offering subsidies to interest rates for first-time home buyers, for example,
Mhm.
there's a lot of money that gets flooded into Fannie and Freddie that, from the budget that offers lower interest rates for people, under certain income limits, things of that nature. And there's all that money in order to offer those lower interest rates goes somewhere, right? But are we really helping that first-time home buyer? Are we really helping them with that subsidized interest rate? Because we're talking like 0.3% lower, which is great, but can that money be spent somewhere else, i.e., offering builders subsidies to pay for the construction of certain portion of the house, whereas that cost doesn't get passed on to the borrower? So in other words, let's just say you have a builder and they say, okay, it's going to cost me $200,000 to build this house. Can I get $100,000 of it covered? Or I'm just using general numbers. Can I get $100,000 of it covered by, federal money so that I only have to charge 300,000 for this house instead of 400,000?
Mm,
Things of that nature. So that's the idea behind it, is to get that more competitive advantage from a builder standpoint to offer them money to build more homes, basically,
mhm.
is the idea behind it.
Yeah, I just was wanted to touch base on that to get your insight and lingo
Yes.
on what that looks
Yes.
like. So thank you for that.
Yeah, and it's interesting to see, like, over the years, I've seen different administrations try to tackle the housing, issue of, housing shortage or higher interest rates or first-time home buyer issues or the cost of housing, things of that nature you've seen throughout the years, different administrations. The Biden administration, if you remember correctly, they started offering lower interest rates to people with lower credit and lower down payments in comparison to people with higher credit and higher down payments. That adjustment has pretty much gone away. I mean, you do get like a better interest rate for a loan amount that's under 150,000, and you also get a better interest rate if your income is lower than 50% of the area median income. So there still is that small adjustment, but it's no longer people with higher down payments and higher credit scores are paying higher interest rates.
Mhm.
That's not, in comparison to, your straight run-of-the-mill market, straight down the line borrowers. So that's the good news, is that we've seen that kind of not be a thing as much anymore as it used to be. So it didn't work. You know what I mean? It didn't really help anybody, because if you have low credit and you don't have high income, the chances of you being able to afford a house in the first place is kind of crazy. Is probably not going to happen. So it didn't help as many people as I thought it would.
Yeah, it was very interesting one to explain to my conventional 20% down clients. I was like, well,
Congratulations, you now have a higher interest rate.
I get it, and yet yeah, that makes sense that it
Yeah.
didn't go as far as planned. So no, that's definitely the other thing too. I was wanting to touch base on again, just watching the news and hearing everything going on. What would it look like if we do go down, the administration goes down the line in the whole rabbit hole of like credit card and that interest rate, or your personal loans or your HELOCs, and taking those interest rates down? Can you talk about that at all and what that would look like, pro and con?
Yeah. So there is some talk about limiting credit card or maxing out the interest rate you could pay on a credit card. So for example, the number 9.99 has been thrown out there,
Hmm.
saying, you know, these credit card companies can't charge more than 9.99% on any given credit card,
Mhm.
things of that nature. So that idea has been thrown out there. The big deal right now, though, is not necessarily the credit card, it's the buy now, pay laters.
Mhm.
The buy now, pay later loans, in my opinion, are pretty predatory as far as the amount of interest they charge, how you pay for things over time, and you're getting a product, and yeah, that's great, but you're paying sometimes two, three, four times the actual cost of that product because you're doing a buy now, pay later. The big thing with buy now, pay laters is also they don't report to credit. So there's really no advantage, for you as a consumer to be able to do those, except for the idea that if you are late or don't make the payment, it doesn't get reported. But the rate of default on those buy now, pay laters is something like 44% or something huge like that. So in order to make things more affordable, there has been talk about, yeah, let's limit the amount of interest you can pay on a credit card. Also, keep in mind the interest that you pay on a car loan now is part of that tax bill. A portion of it or a certain amount of it is now tax deductible. So there are some things that have happened that are going to, that the administration is trying to help with affordability. Will this, all these things put together could help. It's just a matter of time. We just have to wait and see.
Yeah. Yeah, I just wanted to, since it feels like the theme and the topic for today, so just keep bringing out
Yes.
things that I
It
want.
is. Yeah, it is. Like, how can we, affordability is really the huge topic right now, especially with the tariff money coming in. There talks about that $2,000 stimulus check. There's talks about, 50-year mortgages, making things more affordable. How can we do this? How can we do this? And if anyone has kind of just watched the news and things like that, this administration is administration of action in a lot of ways. Like they'll try things over and over. You can kind of see them starting to try things. And, even if they're not all that popular, of things to try, at least, they do talk and there is talk about, actually trying to help, which is nice.
Yeah, absolutely. Well, good. Well, this is another jam-packed, wonderful Monday market update. Really
Yes.
appreciate it. And are we going to meet next week with the short week?
I don't know. Maybe
We'll
we'll
stay
just kind of
tuned.
play it by ear.
Perfect. All right. Well, Nikki, where do they find you with questions or more
Yes, absolutely.
information?
You can find me at Mortgages from MN to AZ on either Instagram or TikTok. Also on social media, or on Facebook, Kevnick Mortgage, or you can find me personally on Facebook as well.
Perfect. And I will also link that below or have that in the notes as well. So regardless of what platform you're watching on, we would appreciate and love it if you would subscribe, follow, like, and comment if there's anything you want us to cover in the weeks to come. We're happy to do that. And Nikki, again, thank you so much for taking your time every week to help us out. It's very valuable and appreciate you.
Absolutely, not a problem at all.
All right. Have a good one.
Yeah, bye-bye.
Bye.